Hey everyone, welcome back to Corporate Decoder, the place where we might just uncover if this company is building houses or just building excuses. Get ready for a deep dive into Cavco Industries Inc.'s latest financial report. Things are looking pretty interesting with their housing and financial services, and we are going to break down exactly what it means for you. And hey, if you dug what we did with the last report, make sure you are subscribed and definitely join our Discord community link down below. Alright, so we are looking at Cavco Industries Inc.'s Form 10Q, which is basically their quarterly report. It gives us a snapshot of how they are doing financially from July through September of 2025. Think of it like checking the pulse of the company every 3 months. Let's jump straight into the financials, starting with their balance sheet for September 2025. The company has total assets of about $1.45 billion. That is a pretty big number, and it tells us they have a lot of stuff that they own. On the asset side, they are sitting on a healthy $374 million in cash and cash equivalents. That means they have readily available money to use. They also have over $24 million in restricted cash, which is money they can't use freely, but is set aside for specific purposes. Now, they are holding about $258 million in inventories. This is mainly the homes they have built or the materials to build them. As housing companies go, it makes sense they would have a good chunk of their assets here. When you add everything up, their total assets are $1.45 billion as of the 27th of September 2025. On the liability side, they owe about $44 million in accounts payable. This is money they owe to their suppliers. Their total liabilities are just over $362 million. So they owe money, but they also own a lot more. Looking at the equity part, it's interesting to see how many shares are issued and outstanding. They have about 9.4 million shares issued, and over 7.8 million actually outstanding. This tells us how much of the company is actually owned by the public and other entities. Their retained earnings are over $1.3 billion. This is the profit the company has kept over time instead of paying it out as dividends. That is a really strong number. It shows they have been profitable historically. And their total stockholders' equity, which is basically the net worth of the company, is just over $1 billion. Now let's look at how much money they actually made. Their net revenue for the 3 months ended the 27th of September 2025 was over $556 million. That is up from about $507 million in the same period last year, so they are selling more homes and services. Their gross profit, which is the money left after accounting for the cost of making their products, was about $134 million. That is a nice increase from $116 million last year. And the bottom line, their net income for this 3-month period was over $52 million. That is a good jump from about $43 million last year. For the 6-month period ending the 27th of September 2025, their net revenue hit over $1.1 billion, which is a solid increase from $985 million in the prior year. Moving on to cash flow, which is super important. For the 6 months ended the 27th of September 2025, the company generated about $133 million in cash from its operations. That is up from about $102 million last year. This increase is driven by higher net income and some smart management of their working capital. They spent about $18 million on property, plant, and equipment. That's like buying new machines or buildings to keep the business going and growing. And get this, they spent nearly $89 million on repurchasing their own stock. They are buying back their shares, which can sometimes signal that management thinks the stock is undervalued. So overall, their operating activities are bringing in more cash, which is a healthy sign. Let's break down where that revenue is coming from. The factory-built housing segment is their main engine, bringing in over $535 million in revenue for the quarter. This segment is doing really well with a 10% increase in net revenue year over year. They sold a lot more homes through their own stores this quarter. That number jumped by 15%, which is really significant. The revenue per HOME sold also went up by about 4.4%. This suggests they are either selling more expensive homes or have been able to raise prices. Their financial services segment also saw growth with a 1.4% increase in revenue, reaching over $21 million. This segment includes things like insurance and financing for manufactured homes. Now let's talk about profitability. Their overall gross profit margin is up to 24.2%. That is an improvement from 22.9% last year. This means they are making more money on each home they sell or service they provide. For the factory-built housing segment, the gross profit margin stayed pretty steady around 22.9%. This is solid performance given the challenges in the housing market. But look at financial services. Their gross profit margin actually jumped to 55.6% from 21.8% last year. That is a massive improvement. They are explaining this by saying they made improvements in underwriting policies and that there were fewer severe weather events compared to the prior year. That is a huge boost in profitability for that division. On the expenses side, their selling general and administrative costs increased by about 7.8% overall. For the factory-built housing segment, this increase is linked to higher incentive compensation due to better earnings. For financial services, the rise is mainly due to increased compensation costs. Their income tax expense also went up, reflecting their higher profits. The effective tax rate is around 22.1%, which is pretty standard. Now let's talk about the acquisition they announced. On the 30th of September 2025, they completed the acquisition of American Homestar Corporation. This is a big deal, adding 2 manufacturing facilities, 19 retail locations, and financial service operations. They bought it for about $190 million funded with cash on hand. This move is meant to strengthen their position in the South Central US market. That is a bold move, and we will have to see how it plays out. Looking at liquidity, they have a strong cash position, starting the year with over $375 million and ending with almost $400 million. Their operating activities are generating solid cash flow. They are telling us their fiscal year ends on the Saturday closest to the 31st of March. It is just a technical detail about how they count the days, but it is good to know how they frame their reporting periods. Now here is the part where companies talk about the future, and it's important to read between the lines. They mention risks like economic conditions, recession, concerns consumer confidence, and trends in interest rates and inflation. These are all standard factors that affect housing companies. Their inventory is at about $258 million. This is a significant portion of their assets, and managing this inventory efficiently is crucial. The balance sheet shows a company with more assets than liabilities, meaning they have a solid financial foundation. The increase in net revenue for both the factory-built housing and financial services segments is a positive sign. It shows they are growing their sales. The improved gross profit margins, particularly in financial services, are really encouraging. This tells us they are becoming more efficient or have better pricing power in that area. The significant spending on stock repurchases is notable. While it can boost per-share metrics, it also means less cash is available for other investments or acquisitions if not managed carefully. Their backlog increased by $13 million to $210 million, which is good news. It means they have a healthy number of future sales lined up. However, notice this backlog is down quite a bit from $276 million in September of the prior year. This could be a small warning sign that future demand might be softening a bit, or they are just selling faster than they can produce. Their investments in available for sale debt securities and marketable equity securities are quite small relative to their overall assets. This suggests they prioritize using their capital in their core businesses of building and financing homes rather than financial markets. The acquisition of American Homestar is clearly a strategic move to expand their reach and capabilities. This kind of consolidation can lead to economies of scale and greater market penetration. The timing of the acquisition right at the end of the reporting period means its full impact we will see in future reports. So what is my take on Cavco Industries? It's clear they are a dominant player in the manufactured housing market. Their financial results show growth and improved profitability, especially in their financial services arm. The acquisition of American Homestar is a bold move that could significantly boost their market share. The backlog decrease from the previous year is something to keep an eye on, but overall the company seems to be navigating the current economic landscape, while the strong cash position and retained earnings give them a good cushion. Alright, that is our breakdown of Cavco Industries, Inc.'s latest filing. What do you think about their aggressive acquisition strategy and the growth in their financial services segment? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more deep dives. And as always, check out the Discord link in the description for more discussions. Thanks for watching, and we will see you next time.